share. So here is an example of a company. It's a good example, and I think you can learn a lot of things from this example. And then apply the same thing in your future stock investment and calculation of PEG ratios and understanding it. So the PEG ratio provides useful information to compare companies and see which stock might be better choice for an investor's need, as follows. Assume company A has price per share 46 bucks at this moment. Earning per share this year is $2.09. Okay, so earning per share last year was $1.74. As you see, company A has increased in earning per share. Very good. Company B has stock price of $80. Earning per share this year is $2.67. Last year was $1.78. Okay. Given this information, the following data can be calculated for each company. So PE ratio is price, which is $46, divided by earning per share of 209, gives you a PE ratio of 22. Remember I said somewhere between 15 and 25 is kind of range that you might look at as a normal range. So 22 is very much there, right, in the normal range. Earning growth rate, it's $2.09 right now. Previously was $1.74. So 209 out of $1.74 minus 1 gives you a 20% growth rate compared to last year. So the other way, if you want to calculate it, and this is confusing for you, this is the easy way that I do. And I always remember how to do it. This is the way I do it. I say, okay, 209, let's use a calculator together so you can see. 209 minus $1.74 earning per share. So earning per share has been increased compared to last year by 35 cents. 35 cents divided by 1.74, and that gives you 20%, 20.1% almost of growth, right? So that is the percentage of growth of this company. Now, PEG ratio is 22, which is price earning, P ratio, divided by the growth of 20. And that gives you 1.1. So 1.1 it's bigger than 1, right? 1.1 is bigger than 1. So here you see that P ratio for this company is 22, and PEG ratio is 1.1. Now let's look at company B and then we read the rest. So PE ratio of price of stock divided by earning per share of 267 currently, it gives you a PE ratio of 30. Okay, so right now you can see that company B technically looks like it's a little bit more expensive compared to the earning per share, which is that's why you got a 30. Here you got 22. So 22 is looking like much more fair price, and 30 looks like a little bit more expensive price. Earning growth rate is again 267 minus 178. Let's do the math. 267 minus 1.78. That's 89 cent increase. 89 cent divided by $1.78 of last year. So that's an increase of 50%. So growth in earning per share was 50% growth. So what is the PEG ratio? PEG ratio is the PE divided by growth of 50. So 30 divided by 50 is 0.6. Many investors may look at the company A and find it more attractive since it has lower P ratio. So if you just look at the P ratio, you're going to say, oh, this P ratio is 22, this one P ratio is 30. So it looks like this is much more fair price. It's better investment in regards to price. And but compared to company B, it doesn't have high enough growth rate to justify its PE. Company B is trading at a discount to its growth rate, and investors purchasing it are paying less per unit of earning growth. And as you see here, this is below 1. So below 1 is good, right? Below 1 is good. Above 1 looks like a little bit, future growth is not that much attractive. So below 1, it's a very good one. So to calculate PEG ratio, an investors or analyst needs to either look up or calculate the P ratio of the company in question. The P ratio is calculated as the price per share of company divided by earning per share or price per share. And you can click this link and then go, I believe, to Investopedia and just look at the video if they have a video or something. So if there's no question on this, we can just move on to the next part.
I have a question. I think it's kind of a silly one because I think I already know the answer. But when we divide by the percentage, it's also divided by 100, right? Because like 50% is 0.5 in my mind, but we just do divided by 50, not 0.5.
Yeah, let me divide it. 30 divided by 50. That's what I'm doing, and I get 0.6. Simple like that.
Okay.
Yeah. So just 30 divided by 50. 30 divided by 50. Whatever the percentage is, just use that number, right? Yes, I know 50%, that means in a mathematical point of view, it's 0.5. Yes. But no, here we use exact the percentage of growth, which is 50.
Got it. Thank you.
And if it is below 1, then it is a good one. Like I was looking in Yahoo Finance few days ago. I look at the company and it was below 1, and I look at another company, I saw it was like more than 1. I realized, then I look at the financials, everything. So it looks like, PE, if you go to Yahoo Finance, you can see. So I don't remember what company was that. But EP, I think. Is this yahoo.com? No, I want Yahoo Finance. Yahoo Finance. And I think it was EP. EP is, yes. Empire Petroleum Corporation. I think that was the company. So EP or ET? Sorry, let me just confirm that before. ET. Because here I see earning per share was negative, and that's why I realized that was it. That was not the right one. ET, Energy Transfer, LP. So this is a company, looks like they do energy transfer of like liquid or whatever, gas or whatever, petroleum. Okay, so you see here the earning per share is 107. Okay, earning per share. Now look at the last 5 years. So in the last 5 years, the company is technically doing fine, and this is where the average is, like almost right there. I can say the average of the last 5 years, like about $11, right? And right now it's $9.83. See that? So, and if you look at here, even here says that it's undervalued. Okay, but you can confirm this by knowledge of whatever we learned today. So by just looking here is undervalued, but we're going to confirm this. Earning per share is $7, so it's good. And also it pays like 8%, 8.14% dividend. So that's also good. So we have a good return on this investment. Look at the target estimate, $15.47. So if you are interested in investing and you have some money, this might be a good way to go for now. And price is very nice. Future target, estimate is good. It here shows undervalued. Earning per share is good. And then if you go to statistics, I believe, and look at the PEG ratio, and that's 0.15, and that's below 1, as you see. Previously 0.12, 0.11. Oh, in 2021, in 2021 was 1.32. You see, at that time was above 1, right? PEG ratio. But by end of the first half of 2021, PEG ratio ends up to be all the way to 0, below 1. So like 0.08 and 0.11, and then it's still right there. So here was high, but after that, it went down. So as you see, it's and if you look at financials, here are financials, let's say. And then you can use, and you have to compare this. This is a gas and power type of company on transportation of energy. So you have to, if you want to use this for your presentation, it has to be compared to a similar type of company. And here is the revenue. Just look at it carefully, how it looks like. This is the last meeting with me, and I like you to get some good stuff at the end. So here is, in 2018, we had 54 million here, which everything is in thousand. Don't forget that. That means there is 30 more zeros here. That means 54 billion. And in 2019 was again 54 billion. In 2020, because of that pandemic, it went to 38 billion, which is understandable. And then in 2021, it picked up, went all the way to 67 billion. So just look at 2021 compared to 2020. It is like twice more, right? Honestly. And then now watch this one. As of today, which is just like barely month 6 of 2022, right? And already we passed the whole thing we did in 2021 in here. In 2021, complete 12 months, we did 67 billion. And here in just 5 months of 2022, we did already 70 billion. So that's fantastic. That's like, looks like we are going to pass 100 billion easily, as you see. Make sense? So look at it and see if and here sometimes gives you similar companies that you might also compare. So if you want to compare this company to one of those companies, here are sample companies that you can compare to this company. Okay, if there is no question, then let us move on. Okay, so chapter 15. Okay, we're going to look at a few things. Let's start from the top and we go there. In chapter 15, we are looking at financial reporting and concepts of financials, like special reporting situations and earning per share. So let's go and cover those one by one. Correction of errors. So sometimes you have to do correction of errors that has been discovered after the fact, after closing. So let's say the company closes in December 31st, and then they find out a problem later on. So if it's sometimes it's necessary to do prior period adjustments to correct errors from prior years. Prior financial statements are retroactively changed to make them correct, and then they have to provide a restatement. The financial statements of prior periods are redone to reflect the correct amount. So let's look at an example here. The following 2015 entry reveals the method of adjusting the general ledger for failure to record depreciation of $50,000 in 2004. So for some reason, they missed that in their adjusting entries at the end of 2014. So in 2015, when they figured out this, it's already late. You cannot record it as a depreciation expense anymore because all expenses are closed into retained earning. So the only thing is left now is retained earning available to you. So you have to debit retained earning. That means to reduce retained earning, and credit accumulated depreciation for $50,000 as a prior period adjustment. And then you do financial statements restatement. So here is the statements of retained earning by end of 2015. It says retained earning January 1st of 2015, as previously reported, was $500,000. However, less effect of correction of depreciation error from 2014, that's $50,000 reduction, and that is because of this journal entry, right? So they show this as a separate line so people can see it, and then corrected beginning retained earning ends up to be $450 at the beginning. Previously was $500, but now we correct it. And then you do the rest as a normal thing. Then you say plus net income minus dividend, and that's end retained earning on December 31st, 2015. Okay, so in case there is a mistake in the presentation of financial statements, normally you might go to prior period adjustments, and this is how you adjust. Discontinued operations are a part of financial statements that needs to be reported separately. The special income statement reporting of the impact of disposing or abandoning of a component of a business. So if a business has been disposed or just abandoned, you need to report it separate line item in the financial statement. So let's look at this financial statement and see how it looks like. So company name of the report for the year December 31st of 2017. Sales is 5.5 million, cost of goods sold. Then gross profit is 2.2. Very good. Then we go to operating expenses, which are general and selling administrative expenses. And we list all those operating expenses and add them up. And we come to income from continuing operation before income tax of 1.1 million, 1,130,000. Income tax will be deducted from that, and then you have income from continuing operation, 730. Up to here, we are good. So far, so good. But the new thing that we are learning is this. After the tax is deducted and you got income from continuing operation, if there is any discontinued operation, then you have to continue and show that. Otherwise, if there is no discontinued operation, then you can call this net income. Okay, 730 will be net income. But in case there is discontinued operation and you need to disclose that, then don't call it net income, call it income from continuing operation. That means those are still surviving and continuing. However, discontinued operation are here. loss from operation of sport equipment units, including loss on disposal of that operation, and that's $600,000. And immediately below that, less income tax benefit from loss on disposal of business unit. If you have a loss here, a loss will provide an income tax benefit, right? And that income tax benefit of that loss has already calculated, income tax is already here. So it's income tax for the operation is already here. But when you show a loss here, then that loss by itself, it has some tax benefit, right? So you need to show that $130,000 is the tax benefit of that $600,000 loss in the financial statements. So technically your loss after tax benefit that you're going to receive, it's only $470,000 damage. Okay, so the damage, actual damage is 470, even though the loss itself is 600, but there's $130,000 of benefit on the tax. So that's actual damage 470. So $730,000 income from continuing operation minus $470,000 loss on the discontinued operations, net of tax. This is net of tax, 470. Then you get net income of $260,000. So you have to show this completely separate from your continuing operation. Okay, makes sense hopefully. But sometimes it's not discontinued operation. It's just one of the locations are, let's say, closed or sold. Operation is the same operation, but just one of the locations are closed. That's normal. That's fine. So in that case, you show that you have sales, you have cost of goods sold, you have gross profit, operating expenses are 635, rent for salaries, rent, operating, and then you have a loss on sale of Georgia location. That's fine. You show the actual loss on sale of that location and add them up. And in that case, you have just, income from continuing operation before tax of $1,470,000. One thing that normally I do, and here is not showing, is you show the salaries, rent, other expenses, just like this. And you show the total in here, 1.70, and then you show income from operation, not continuing operation, but just operation, income from operation, 130, and then below that, but above income tax, right here in the middle, you have other revenues and gains, loss or expenses. Those are like interest expense, interest income, loss on sale of equipment, gain on sale of equipment. Those things will be right in the middle here, above income tax, but below income from operation. Okay, income from operation below it, but above income tax. I normally don't put it here in the same lineup in here together because these three things are operating expenses, and operating expenses are general and selling and general administrative expenses. If there is any loss or gain on sale of equipment or location, any interest income, interest expense, those are other things. That's why they have to go below income from operation, which is below 730. I mean, below 130 right there, but above income tax. Below 130, but above 400. And then income tax will be a last thing, and then you have net income. Make sense? Okay, what is comprehensive income or OCI? Comprehensive income is net income, whatever it is right here, like net income, plus item of other comprehensive income, like market value adjustment of available for sale securities. Let's say you have securities that you have it as, and you identify them and classify them as available for sale. By end of the year, I'm not saying you sold it, but if you sell it, will you have any loss on that? Will you have any gain on that? So it's unrealized. Makes sense? Unrealized gain or loss. Let's say from also you have some accounts receivable from China, and you're gonna receive Chinese money, and if you translate Chinese money to US dollar amount, then you will have some probably gain on that translation or sometimes loss on that translation. So there are sometimes things that needs to be, even though you are not realizing yet, but you have to recognize it as comprehensive income, which is net income plus those other stuff, other comprehensive income. So in this example, let's say we have an income statement, and then right below income statement, you start the comprehensive income. So that's why you get statements of comprehensive income instead of calling statement of income statement. So sales is whatever it is, cost of goods sold, gross profit, normal, operating expenses, add them up. Income from continuing operation is 1.2 million. And then other taxes, income taxes, 500,000. And that gives you 700,000 income from continuing operation. Then you have discontinued operation, which you saw how much, let's say, profit or gain you have. Here is a gain on disposal of units, food processing units, less income tax on disposal of this business unit because you have a gain, so you have to pay taxes. So less that tax. And then net of tax, it goes here. Gain on discontinued operation net of tax is 1250, and 1250 minus 700. That's gain 1250 plus 700. That's 1950. That's net income. And then below net income, you have other comprehensive income adjustments from certain investment. Those are investments available for sale, let's say. And if you have any possible gain or loss on that at that moment on December 31st, you need to recognize that as unrealized gain on the investment. And you put $100,000 in here. Now here, when I say unrealized gain here, that's why it goes in the comprehensive, because it's unrealized. And we call it other comprehensive income. And your balance sheet will be adjusted for that. Not the balance sheet, but the stockholders' equity. Stockholders' equity will have an adjustment for these income adjustments because of this possible gain. And that's $100,000 additional in stockholders' equity. So the comprehensive income right now, instead of just net income, now you show that comprehensive income from that unrealized investment gain, and you have $, double line at the end, and you call it comprehensive income. So net income is above, comprehensive income is below. Changing accounting methods, you might have changes from one acceptable method of accounting to another acceptable method, like straight line depreciation to a declining balance approach. If that happens, then and if that happens and it is accepted because you have very good reason to do that, you cannot just do it because you like it. You have to do it because you can prove it why you think it's better to do that way, even though both of them are acceptable, but you cannot just flip-flop on those methods because you like it that way. But assuming you can have a good reason and your auditor is also fine with that, and then you can change that depreciation method from one method to another. But in that case, you might have to go to retrospectively do some adjustments, which is revision of financial statements for prior period to reflect the application of current changes in accounting methods. So because if your investors are comparing your last year financial data compared to this year financial data, you have to provide a retrospective adjustments to the last year financial data. So when you put it next to each other, your investors can easily understand what's going on. So this is the word. That means that the financial statements of prior accounting periods should be reworked as if the new principle had always been used. And of course, you have to have disclosures too, okay? This is important. Do not confuse a change in accounting method, which is you have to go retrospectively and adjust prior period, with a change, not adjust prior period, but rework your financial data, okay? Not adjust prior period, but just rework your financial data. But sometimes you have change in accounting estimate. If it is change in accounting estimate, then you don't need to go retrospectively back and rework your financial statements or anything. You just need to, go prospectively forward, and starting that moment, all your financial statements will be prepared based on that estimate. Let's say previously you estimated your useful life of the equipment is 5 years, but now you believe is 7 years. So just because of that, so starting that moment, because of change in estimate, now calculate your depreciation expense again based on 7 years life. And starting that moment, you just go prospectively forward and prepare your financial statements without changing any financial statements from previous period. There are a few words that in accounting you might see. They call it EBIT or EBITDA. EBIT is an analysis calculation of earning to reflect earning before interest and taxes. So earning E before interest and tax. They want to know how much company's earning is before any interest or tax. But EBITDA is the calculation of earning before interest, tax, and depreciation and amortization, EBITDA. And depreciation and amortization will be added in this EBITDA compared to EBIT, because technically for depreciation and amortization, even though you recognize them as an expense, but honestly, you don't technically pay for it. It was paid already the moment you bought the equipment. So right now you are just recognizing the depreciation or amortization, but those are non-cash expenses. So to understand the real income of the company, you use EBITDA to understand what is the actual earning before any interest, any tax, any depreciation or amortization. And what do you use for this? Here is the word. It says these numbers are sometimes used in evaluating the intrinsic value of a firm. So for business valuation. In that, they reveal how much the business is producing in earning without regard to how the business is financed and taxed. These numbers should be used with great care. They can provide an overly simplistic view of business performance, but overall, you need to understand the actual earning potential potential of this business. So you use it for business valuation. Earning per share, I already explained that, so I'm going to pass that. This is the basic earning per share, which is income available to common stockholders divided by weighted average number of shares outstanding. That's basic earning per share. But sometimes we have a dilute income per share, also diluted, so that will be separately calculated in a different manner. But the basic earning per share is income divided by income available to common stockholders. Why we say income available to common stockholders? That means net income minus preferred dividend. Net income minus preferred dividend divided by weighted average number of common shares outstanding. So here is for 3 months, we have 1 million shares outstanding. So 3 out of 12, that gives you, for 3 months, we had 1 million. So 3 out of 12 times 1 million, that gives you a weighted average of 250,000 shares for these 3 months. For the next 7 months, we issued 200,000 more shares. So for 7 months, we had 1 million share plus 200, which is 1.2 million shares outstanding. And that's 7 out of 12 ratio times 1.2 million shares outstanding. That gives us a weighted average of 700,000 shares. And then for the last 2 months of the year, we had a treasury stock buyback of our own stock by 120. So the number of shares outstanding for the last 2 months was only 1,080,000, and 2 out of 12 months times 1,080,000, that gives us about a weighted average of 180,000 shares. We add them up, so weighted average of shares outstanding for this company ends up to be 1,130,000. So this is very important way to understand how you calculate the weighted average of shares outstanding, because in some cases you have 1 million shares, let's say for the first 3 months, and then later on it changes. So diluted earning per share is an earning per share number adjusted to reflect the potential effect of dilutive securities. Dilutive securities, those are things that might happen, but it doesn't mean it has happened already. For example, there are some bonds that might be converted to common stock. Those are convertible bonds. Okay, we are not saying that it's actually happened, but we are saying it might get converted. If that converted, then the number of shares outstanding will be diluted. And then you have to calculate the diluted earning per share, which is showing you the worst case scenario, assuming every single thing that might be converted to common stock gets converted to common stock. So companies with options, warrants, convertible bonds, and stocks, they might result in issuance of additional shares, right? That's why we call them complex capital structures. Those are capital structures of company that has some options, warrants, convertible bonds, or something like that, that can be converted to capital, common stock, and dilute the weighted average number, which is like here, 1,130,000, for example. Okay. P ratio, we talked about that already, so let's move on. Book value per share. So this company has, let's say, common stock of $1 par value, 2,000 shares authorized, but 500 shares are issued and outstanding. Okay, paid in capital in excess of par is, let's say, $10 million. This is additional capital has been raised by issuing stock. And retained earning is $1,500,000. Stockholders' equity is $12 million. Okay, and
I have a question.
yes.
Does the number of authorized shares include hypothetical shares like the convertible bonds?
No. This is authorized shares authorized on the very first day of this corporation. When they establish the corporation, they need to come up with a maximum authorized shares that a company can issue. And they put some number. Sometimes they say 3 million, 5 million, 10 million, whatever they like. And that's authorized. That doesn't mean it issued, because when the company started, day one, it's authorized 2 million, but issued 0. And then on day one of going public, like IPO or whatever, then they, let's say, issue shares. So at that moment, so they decided, let's say, to issue 500 shares out of this total available 2 million. So this 2 million is just saying how much maximum they can issue.
Right. So then they have to be careful if they put out like convertible bonds, because then someone will try and convert. And now you need more common shares, right?
Yes, bottom line, it shouldn't go above this 2 million.
Okay.
So whatever they have outside as a possible convertible bonds or whatever, in assuming they convert that, it shouldn't go above authorized.
I see. Thank you.
Yeah, but it is possible down the road to change this 2 million number, but they have to do the paperwork and, in the corporate bylaws. So they changed this 2 million to 5 million, maybe 10 years from now, whenever they like. But for now, it's just a number sitting there, showing maximum what might happen. This is the maximum situation. But sometimes you have 2 million authorized, but you don't have any warrants, any convertible bonds or anything, nothing. That's fine. Just this number will sit there, but this is the number is important because I want to see how many shares are issued and outstanding. Because if this issues is 500 and outstanding is, let's say, 400, then I know there's 100,000 treasury stocks waiting here at the below right there. But if I see it says 500 shares issued and outstanding, that means there's no treasury stock. So book value per share, that means common equity, which is, let's say, $12 million, I believe, divided by common shares outstanding, which is 500,000. Do I have the calculation somewhere? No. Okay, so but that's what book value is. Common equity here, and divide by common shares outstanding. Okay, let's look at this example. So the Mueller Corporation has capital stock of preferred and common stock. So preferred stock has $100 par value, callable at 110.6%, callable at 110, and 6% cumulative dividend that needs to be paid. And it's cumulative. That means if 1 year they miss, the next year they have to pay it for both years because it's cumulative. 300 shares are authorized. Only 100,000 shares are issued and outstanding. Okay. And callable means the company can call this preferred stock back from shareholders and give them $110 for it. That's why it's callable. However, common stock, it's $1 par value. 100,000 shares, 1 million shares authorized, 600 shares are issued and outstanding. Additional paid-in capital dash preferred stock is 700,000, dash common stock is 20 million. Total paid-in capital is 31,300,000. Retained earning is 4.9 million. Stockholders' equity is 36,200. Okay. Mike is a financial analyst for an investment fund and is evaluating the Mueller's Corporation. Pursuant to the task, he's diligently combat through the notes to the financial statements and found that preferred dividend were not paid in the current or prior year. Oops. Okay, so it's not paid for 2 years. And as I said, here is cumulative right there. You see cumulative? So that means they have to be paid for both years. He notes that the annual dividend is 600,000, which is 6% of 10 million. So 6% of 10 million is 600,000 annual dividend. For 2 years, they are in arrears. So that means they have to pay for both years. So 600 plus 600 is 1.2 million that needs to be paid. So here you have total equity of 36,200,000, which is good, but you need to be careful because there are in arrears. So there are call price of 110%. So in case that happens, so that's $10 billion times 110%. That's $11 billion for the call price. And dividend also needs to be paid for 2 years in arrears. So that's 1.2 million. Total is 12.2 million less 36,200,000. That gives us finally a residual equity for common shares. This is 24 million actually available instead of just saying, oh, this is 36.2, let's calculate the book value. So this is what realistically you can get out of this. So 24 million divided by 600,000 common shares outstanding here, right there. And that gives you a $40 per share, just the book value, right? Imagine the stock price of this corporation is, for example, $60. So if you are paying $60 for the stock price of this corporation right now, just so you know, $40 is just the book value of the share. And you're paying just $20 as a form of, extra or goodwill or whatever you call it. And that's why the market price right now is 60. So you know that the book value of the company is already $40. So anything above that, you are paying as a premium to buy the stock of that corporation. Dividend rate and payout ratio, that's very important. So dividend rate is dividend per share divided by stock price. How much dividend you get per share for every $1 of stock price. Or they call it dividend yield, which I told you, put that information in your PowerPoint presentation. So we know what is the dividend yield. So dividend rate is, or dividend yield, is annual cash dividend that you receive for every dollar of price that you paid to buy one share of that stock. So let's say you buy it for $100 and you get $5 dividend. So $5 out of $100 stock price, that gives you a 5% yield. Dividend payout ratio is annual dividend, annual cash dividend divided by earning per share. Okay, so every company has, for example, some positive earning per share, right? How much of that earning per share will you get as a form of dividend from this company? And let's say in this example, it says $30 earned, $3 per share, earning per share, $3. Its payout ratio is 0.3333. That means $1 out of $30. If they pay you $1 dividend and they have $30 earning per share, then payout ratio, that means is 33.3%. So that means the company is paying almost 33% of the earning to shareholders as a form of dividend. And what do they do with the rest, 67%? With the 67%, they hold it in the retained earning, and they might put that into new investment, equipment, or something like that. But if, let's say, the earning is 50 cents, earning per share, so $1 out of 50 cents, dividend payout ratio of 2, that's 2. That means the company, if payout ratio is 2, that means they are paying twice more dividend than earning. And that will be a question mark. One would begin to question the safety of dividend. How long someone can do that? How long someone can earn just 50 cents and give you $1 for the dividend? Okay, maybe that happens for a year or two, but they cannot continue that like that. So, but there are companies that they have a high, like Ford, I remember previously had a few years ago. I'm not sure yet right now, but they had a very high earning payout ratio, like 67% or something like that. Let's go to let's say let's say this one. Maybe we can find this here. Okay, it's not here. I have to see how much the earning is and then calculate it. So, but bottom line here is the idea. How much they are paying dividend for earning per share. Rate of return. Okay, rate of return. It's kind of long-term solvency type of. It's a profitability ratio of how much company is generating profit, which is profit on every $1 of asset investment that they have. So it is net income plus interest expense that they normally pay, and it's deducted from net income. So you put this back to kind of get the actual net income divided by average asset. So looks like for every return or profit the company has compared to average asset, how much profit they are generating. If I have an example here, I don't have it, so I make one. So let's say net income is $100 and interest expense is, let's say, $20. So net income plus interest expense is $120 actual return on average asset. Let's say average asset is $1,000 average asset. Average asset comes with beginning asset plus ending asset, total asset, divide by 2. In some cases, we calculate this average asset as average operating asset. Operating asset, those are PP&E, property, plant, and equipment. Or you can just go with average asset if you like that way. And that way you know how much is the return of every $1 of asset. Same thing you can compare as a profitability ratio, the return, which is profit, on every $1 of equity. Okay, the return profit is net income, yes, but the company has to pay the preferred dividend to preferred stockholders. That's something that they have to, right? So net income minus preferred dividend, that gives you the real income, divided by average common equity and how much dollar equity they have. And they see, okay, how much the return is in compared to the every $1 of equity. So that gives you the return on equity ratio. So you have return on asset and return on equity. Either one of them can be used as a profitability ratio. And you can do both of them just to be sure and see the whole picture. And here are some characteristics of financial information that you provide to your shareholders. I want you to read this and understand it. If you are going to become a CPA one day, then you might get a question in this in your CPA examination. Other than that, it's just talking about that information that you prepare for your investors and stakeholders has to be relevant and has to be truthful and faithful. Okay, and also the information you prepare should be comparable. It shouldn't be like a jungle that no one can understand it. So it should be comparable and it should be consistent. Let's say if you use, first in, first out method for your inventory calculation, every year you have to use first in, first out. It should be consistent. It has to be verifiable and it has to be timely. You cannot prepare your financial statements 3 years after the fact. It's too late. And your financial statements has to follow GAAP and be understandable for a reasonable, business person. And this is the development of GAAP. Again, I like you to just read it, understand who is making GAAP, which is FASB, and accounting standard updates, which is ASU. It's just an information to update the accounting information. And there's some ASC, that's accounting standards codification, which is GAAP. So ASC is new GAAP. Previously, GAAP was so all over the place and complicated and harder to find out what is where and how to locate it. But a few years ago, about maybe 10 years ago, so they came up with a very good, more than 10 years, maybe 15 years. They came up with a very good structured GAAP, and they called it accounting standards codification. And I have a video somewhere at the beginning, I remember, that I told you how to find GAAP, and that takes you exactly to ASC codification. So here are things for you to read related to accounting and the history and who is making it. There are some assumptions in accounting that we constantly use. Entity assumption, that means information that we use in the accounting should be specifically belong to that specific business. You cannot put and mix two different numbers from two different businesses some way, somehow, that you end up having a good result. Every business entity has to be accounted separately. That's an entity assumption of every business. Going concern, that means if there is any issue in future in regards to staying solvent and staying in the business, needs to be disclosed. If not, we always assume that business doesn't have any going concern, and if there is any going concern, needs to be disclosed. Periodicity means every financial statements you prepared belongs to a specific period, and you cannot mix, let's say, 2020 information with 2021 information. Monetary unit means we have always an assumption. If you use dollars, that means you always talk about dollars. You cannot say, oh, over there was dollar, over here was euro. No, if you talk about dollars in your financial statements, you always stay with that dollars. If you talk about euro, then you stay with euro. That's the assumption about monetary unit. Okay, this is the part that I was telling you. Let's say you have an accounts receivable from China and you are involved with global trading. So you sell, you buy inventory from, let's say, somewhere, and that's your inventory. Very good. And then now you have an accounts payable because of that. And that's by, how did you get that $18,000? Because purchase bicycle is agreeing to pay 20,000 Swiss francs in 60 days. Spot rate at that moment was 90 cents for each Swiss franc. So 20,000 Swiss francs times 90 cents. So that ends up to be $18,000. You recognize that, very good. However, by end of the year, the spot rate ends up to be 95 cents. So at that moment, because you owe 20, so the 20,000 Swiss franc times 95 cents, that's $19,000 liability. Here you have $18,000 liability recognized. So by end of the year, before you prepare your financial statements, you do an adjusting entry, and you recognize that you have possible currency exchange loss, and that's where it goes into other comprehensive income. Remember that other comprehensive income? I said those are things that didn't happen yet, but didn't realize yet, but you need to recognize it. So that's where technically the recognition comes at the end of the year. But if it's not the end of the year yet, and you just need to pay it because it's right in the middle of the year, that's fine. So you just write a check for $19,000 just to pay the liability, close your accounts payable, and record a loss. In this situation, because it's not end of the year and it's actually happening, so that's fine. You just record it as regular loss. This is the end of year example. So in this accounts receivable, let's say you sold something to England, agreeing to accept 100,000 British pounds, and that's spot rate of $1.75. So that's $175,000 accounts receivable at that moment, right? But that was in December 1st. But right in December 31st, you need to prepare your financial statements. So, okay, you didn't receive anything yet. So all you need to know is what's the spot rate. Spot rate is $1.90 compared to $1.75. Now it's $1.90. So if you receive 100, which is 100,000 pounds times $1.90, that's $190,000 receivable. So 190 minus 175 that you already recognized, that's $15,000 of gain. Just that easy, right? So you increase your accounts receivable at that point, and you record the currency exchange gain of $15,000 at that moment, and accounts receivable goes up, and currency exchange gain will be recognized. And let's say 2 months later, you receive the cash for $170,000, and currency exchange up. The spot rate went down to $1.70, and $1.70 times 100,000 pounds is just $170,000 cash that you're going to receive. So at that moment, you have currency exchange loss of $20,000 to recognize and accounts receivable of $190,000. That's one way to do it. There's other way also to do it, but this is still good enough for us just to know. So bottom line, when you have any receivable or payable and it needs to be translated to dollar, if at the end of the year, if there is any gain or loss needs to be recognized.